Welcome to Realty Bytes, conversations on real estate and lifestyle, the podcast that empowers you to make informed decisions about your real estate investments and create your dream lifestyle. Join me, your host, Evelyn Lopes, and industry experts each week for timely insights, tips, and tools to navigate the complex world of real estate. From market trends and financing to savvy investments, design, and decor, we cover everything you need to secure the home you've always wanted. Join us on Realty Bytes conversations and embark on an exciting journey towards a better home and a better lifestyle.
Self-employment is a fulfilling and rewarding career, but it also can present itself with some unique challenges, especially when it comes to financing and qualifying for a mortgage. As a self-employed individual, you may be wondering about the process of purchasing personal investment property and what steps you need to take in order to secure financing. Today, we will be exploring the process of buying property as a self-employed individual and discuss key considerations to consider when it comes to financing and qualification. And we're going to dive into a discussion with our special guest and mortgage broker, Nick Tavernesi with Dominion Lending.
Hello.
And Nick's going to help us gain a deeper understanding of the process and what you can expect as a self-employed individual looking to purchase property. Good morning, Nick.
Good morning, Evelyn. Thank you for having me. It's good to be here. Hopefully, I could shed some light on the subject for you and your listeners.
I'm sure you will. Now, Nick and I have had years and years of working experience together, and I know that Nick is a very knowledgeable mortgage broker, and that's why I've invited him to speak with us today. So, Nick, why don't you just tell the listeners a little bit about yourself and your experience?
I've been lending probably just over 33 years now. Started way back with Royal Trust in 1990, and then moved over to Canada Trust for a few years. Then jumped over to Royal Bank and recently joined Dominion Lending Centers. So it's been a long and great career so far.
Right. And with that 33 some odd years of experience, you've been through all different types of market conditions.
Oh, my goodness. Yeah.
So I'm sure that you can provide a lot of insight into the different ways people can get a mortgage in these markets.
We've seen it all, but and I guess the reason why I've been in the business that long, it's been different. Every day is different. And the market today is different. And we've never seen this in 33 years. So but that's what kept me in the business.
Right. It's exciting, right? It's like I've been doing this for 36 years and the same thing. Every day is different. Every individual that you work with has a different set of circumstances. And it's just wonderful, finding out what's important to them and helping them achieve their goals.
Exactly.
Yeah, very, very rewarding.
Yeah.
So as we're beginning, maybe you can share with our listeners the difference between a mortgage specialist and a mortgage broker.
So in my previous roles, before joining DLC, I've always worked with Royal Trust and Canada Trust and Royal Bank. It was always working for that one lender. It was great, but they had great products and rates were okay. But I think now joining DLC, I have probably about 120 lenders at my fingertips that we could offer clients. And that basically allows us to give, I think, better advice than my previous position, my previous employers. That one, that they were only allowed to look at that one product that the bank or the trust companies were offering at that time. So with 120 lenders, we're not going to deal with 120 lenders all the time, but it's good peace of mind to know that you can take care of your clients. If it's doable, the deal, it's going to get done through the broker channel.
Right. So it gives basically the client options, right? So as opposed to going to a mortgage specialist, specific institution, working with a broker, you can find out, what I guess the client wants and needs, and then you can match them to the specific lender that can fulfill that requirement.
And that's where that advice piece is a little bit greater here with DLC. We have the option to give that little bit extra, that extra step that gives that better advice.
Just so our listeners understand what DLC stands for, it's
Dominion Lending Centers. And we're the largest brokerage in Canada, or one of the largest in Canada.
Okay. Yeah. Excellent. So I know a topic that's on a lot of people's minds right now is interest rates.
Mm-hmm.
So we had some really amazing rock bottom interest rates during the pandemic, when the government basically forced those rates to go so low to keep the economy going. And then all of a sudden, last year, I guess in March, they started aggressively increasing the lending rate. And yesterday, we just saw another quarter point basis increase in the Bank of Canada lending rate.
Yeah.
So I know a lot of people are wondering, where are mortgage rates heading in 2023, and how is it going to impact me as a buyer or a homeowner?
With what's happened with the rate so far, I've never seen the qualifying rate this high. And then it makes it, when the rates and the qualifying rates are this high, it makes it difficult for borrowers to qualify. So hopefully where we think rates are going to go, maybe later on this year, they might come down, but possibly next year. As far as the overnight rates or the variable rate, the Bank of Canada was saying yesterday that it's going to put a hold on that or any more increases for the time being. But if they feel that the inflation is still a problem, they might increase it again. But right now there's a hold. So if my opinion from what I'm hearing is the rates are looking to be maybe coming down later this year or early next year.
Okay.
Yeah.
That's good to know. And although the rates are higher than what we've experienced during the pandemic, I think what people forget to keep in mind is that they're still historically low. It's just that we've been so used to 1.9, 2 point, a little bit, that when you see a rate 5 and over, you start freaking out. But it is historically
low. Like when I started back in 33 years ago, 5-year term was probably around 14 3/4%. And compared to today, that's a big difference. But the prices back then were not what they are today. So, but are we going to get back to the rates of 1%? There are economists are saying probably not.
Mm-hmm.
Those 1%, 2% rates probably are gone for a while.
Mm-hmm.
But historically, today's rates are still low compared to when I first started in the business.
Mm-hmm.
But it is making it more difficult for people to qualify, for those first-time buyers especially.
Right. And so I know when I started, rates were about 18%. We used to buy them down to 14%.
Yeah.
So now with the new economies that we're seeing, we're seeing more and more individuals opting to work for themselves.
Yeah.
And start their own little business. And with technology, it makes it a whole lot easier than it was before.
Mm-hmm.
Now, working for yourself has some great benefits, right? It gives you some freedom. It allows you to work and build your own business, and you can do it your way. But there's also some drawbacks. And I think the big drawback comes when you work for yourself, especially when you first start out, and now you want to buy a home. Maybe you've got good income coming in, but you're new.
It's not provable.
Mm-hmm. So maybe you can talk, first of all, about what types of things lenders are looking for in general when a person is looking for a mortgage, whether they're self-employed or not. What kinds of things do they look at?
There's really 3 things that lenders going to look at: income, credit, and down payment. Now, traditionally, if we're talking about the salaried individual, it's pretty easy to confirm that income. It's basically a pay stub, a letter of employment, and maybe a T4, or if we have to use an average income, maybe 2 years T4, and that's it. But when it comes to the self-employed individual, traditionally, we would look at a 2-year average based on their net income, line 15,000, for example, on their notice of assessment. And that would be the way the bank would say, this is what you qualify, because that's what you're telling the government you earn. But as you know, a lot of business for sale people don't really declare, their actual income. They have write-offs and they bring that taxable income quite low, so taxes are minimized. But we have programs where people have, or business for sale people have a good down payment, let's say 35% down. They have the good credit. They have good assets on the application. For those people, we have a stated program, a stated income program, where the income verification is we verify it non-traditional ways. So in different institutions, different banks that I'm going to work with have different ways of establishing that non-traditional income. So we're able to help those people that are declaring a lower income, but actually, if we look at their financial statements, and there are other, bits and pieces of their application, you can see that they're pretty responsible individuals, and we can make a business case to the fact why their income is being declared so low, but they're still able to keep their credit clean, make good, accumulate other assets. So there are programs for those self-employed individuals. The self-employed are always worried that they're not going to get approved, but we have programs for those individuals.
Right. Now, just to confirm, at a minimum, those individuals would have had to have filed their taxes for 2 years?
2 years.
Okay. What about if that individual was, say, working in a business or working in a field and they worked for a company and then they decided to go on their own, but they're in the same line of work? Does that work for or do they still have to be a minimum of 2 years in that business?
So for the mainstream banks, they would like to see a 2-year history. But when we have good credit and we have a good down payment, with all those 120 lenders that we're working with, we're going to possibly find a home for that application. But when it's that difficult or that creative, what is it going to cost that applicant to get that deal done? So first of all, what's the rate going to be? Is there going to be any lender's fees because it's not fitting the boxes of the traditional lender? So yeah, we can get it done, to answer your question, in less than 2 years, but at what cost?
Mm-hmm. And I guess for those people that have a business and keep their funds within the business to invest in their business and take a very small portion on their own.
Yes.
Do they take into account what's in the business or?
And under the stated income, yes, we look, when I was with my previous bank, exactly what we would look at is the financial statement, look at the retained earnings, look at the gross revenue, because when we were using that non-traditional income, and we would take we would take the net income of that individual and multiply by a factor just to beef up that income, to give them more income. Our underwriters felt good in the fact that there is good retained earnings, good gross revenue. But unfortunately, the net income that applicant's declaring doesn't jive for that particular business or that situation. But we understand, the banks understand the business people more than they did when we first started. So, which is good news for the self-employed.
Mm-hmm. Okay, so they need to have some kind of income or stated income. And you mentioned that they also need to have, obviously, good credit. So
good credit.
Maybe you can explain what the banks are looking for.
If you're looking at stated, the credit, the banks, hang their hat on the fact that we're already making an exception on the credit or on the income. So the credit's got to be pretty stellar. I would say, no less than 650 beacon. And I would even say 700 beacon score for a stated income. But different lenders have different underwriting. So, these are just my thoughts on what the lenders could do out there.
Right. And maybe you can just let everybody out there know what is the range of what credit scores lie.
Well, the best score that anybody can get, and I've seen probably a handful in my career, it's 900. And it can go below 6, the 5s, anything under 650, I start to get worried. So there's got to be an explanation on, why the credit's so low. But the best score that anybody can get is a 900 score.
Okay. So we've talked a little bit about stated income, having your taxes filed for 2 years. We talked a little bit about credit. And then you mentioned that the third component that the financial institutions are looking at is down payment.
Yes.
So if you are self-employed, what is the minimum down payment that the banks would consider?
So on the traditional route, let's say I'll talk about the traditional. Normally, we have lenders that would do 20%. The traditional is 20%. And then we would use the net income from the notice of assessment for averaged out over 2 years. But if we're looking under the non-traditional, conventional, where we would ask for at least 35% down. If we can also look at an insured stated income, where the lender actually gets the insurance, but the applicant gets the benefit of coming into the market. But those products I've done a few, and they're more the target for those business for self that are cash driven. So like, let's say a convenience store, a convenience store owners applying, and they would have less than the 20 and maybe as low as 10% down. So they can buy a property up to $1 million, probably up to $1 million, as long as they have the 10% down, and we can prove the stated income that might fit that program. So to answer your question, you can go as low as 10% down, maybe 20% down, and 35% down, depending on the situation of the applicants.
So what is some advice that you can give self-employed people that are looking to invest in real estate?
At tax time, make sure that you're declaring enough income, because it's good not to pay minimal taxes, but you're sort of hurting yourself when you come to us when we see very low income on those notice of assessments. So just maybe talk to an accountant or somebody that can help you to determine how much income you should be claiming, just when you come to a bank, you have some income showing on those notice of assessments. And the other thing is keeping that credit clean. Make sure that you're making your payments on time, keeping those facilities at, if you have a credit card limit at 10,000, make sure you don't go more than 5,000 of that limit, because if you start going more than half of the limits, it hurts your credit. And then, just save and accumulate in savings and investments as much as possible.
Okay, so that's a question for you. So say a business has a limit of 10,000 and their expenses every month are 8,000, but they pay it off in full at the end of every month. Is that still?
Yeah, that's okay.
Yeah.
But it's bringing their credit, like the limit on their facility is 10,000. It's bringing their credit rating down somewhat, because they're pretty close to that limit, and the credit TransUnion or Equifax will score that differently, more of a negative, because
even if they're paying it off in it.
Yes. Yeah.
So maybe what they should do is look to have credit increased if they can.
If they can, yes, that's a good idea too. Yeah. Okay. If they're finding that they're that close to that limit, then maybe look at having your limit increased.
Right. And does the credit of the business come into play as well?
No,
it doesn't.
No, it would be under the residential side.
Right.
So you're applying personally. So the credit of the business does not get involved. It's just personal credit. So if it's a personal credit card, personal car loan, and it's under your name and not under the business name, then that's what we look at. Now, people will have a car loan and say, well, my business pays for it. Mm-hmm. But unfortunately, you've signed for it and it's coming up under your personal credit. Mm-hmm. So we have to take that into account.
Okay, well, that's a good point, because I'm sure that's how it works in a lot of cases.
Oh, yeah. Oh, no, my business pays for it.
So, Nick, what about an individual who has a business and their business makes good money, and they've got a lot of money sitting within their business, and maybe they want to take that money and purchase a home under the business? Is that possible?
It would be an exception to use business funds as a down payment. I have done it in the past, but they could use the business funds to buy a personal primary home or an investment home, but it has been an exception in the past. If you were looking at holding companies versus an actual transaction company. So some people have gotten questions where I want to buy a property under a holding company. Well, a holding company, you can look at buying under the holding company, but that holding company cannot have regular business transactions. The holding company that you're buying that property under would only hold investments like properties and other investments.
Okay. What about buying the property fully under the business name? So maybe it's a secondary property and they're doing it as an investment property through the business. And I guess my second question is, can you buy, I guess that's what you said, you can buy
under a holding company.
under a holding company, but not under your business company.
No. If you're buying it under your business, then it doesn't fall under our residential umbrella. So then you have to go and speak to business banker about that, right? But under the residential side, even if you have an offer, I've seen offers come in under a business name that is not a holding company. It's a regular transactional business, and we won't allow that under the residential side. We would have to look for somebody for commercial side to do that mortgage.
Okay, so so that's a good point to bring up. So basically, you deal with residential purchases, and if someone is buying a business purchase, like through the business company, then they have to go to a
commercial side.
Commercial.
In DLC, we can look to work with our commercial people, but I would have to partner that off with somebody else. And even in the banks, when I was with the banks, it wasn't on our residential side. We would refer that off to our commercial banking if they want specifically their transactional business to buy that property.
Okay. Now, if it's an individual who is looking to buy an investment property, that's not considered commercial, right?
No.
It's considered an individual with investment.
Well, it is a residential if it fits our criteria for a residential. So, we'll have a building that has 2, 3, up to 4 units. That's the criteria under the residential side. If it goes into 5 or 6 units, that could become, you can look at it again under the commercial side. So under the commercial side, fees, rates differ.
Okay, so there's actually 2 components then. For commercial, it's if the business is buying the property under their name. And secondly, is the property got 5 or more units within it, that also would be considered
commercial. Yeah,
okay, that's great to know. So thank you so much for sharing all that great insight. It covered a lot of questions. I learned
my pleasure.
New things, as I always do when we speak. How can people get in touch with you if they would like to have more one-on-one?
They can reach me at my cell, or my email address is approvalsbynick@gmail.com. My cell 416-573-2641, and that number's been around forever. So yeah. And I just want to say thank you. It's been fun, Evelyn.
Yeah, it has been fun. And we'll put your contact information in the show notes as well.
Beautiful.
If anybody wants to reach out to Nick Tavernesi with Dominion Lending Centers, we'll have the numbers down below. So thanks, Nick. And hopefully we can have you on again and talk about
look forward to it. I look forward to
more money matters.
Thank you, Evelyn.
Thank you.
Take care, everybody.
Bye.